Investing fees are the price that you pay to invest in the stock market. The amount of fees that you pay have a direct influence on your returns, so you should be looking out carefully when selecting which funds and which providers you invest with. The bottom line is, the more fees you pay, the less of your returns you're going to see. Fees commonly lie in the 0.05% to 2% range. However, you can get fees that are cheaper than this, and there are definitely some fees that are much more than this. For low-cost fees, there are companies such as BlackRock and Vanguard that offer fees as low as 0.03%. However, some of the top hedge funds can charge fees of above 10% per year. The question is, why are investors actually willing to pay this much in fees when it comes to investing? Make sure to stick around to the end of the video where we give an overall summary on what we think about fees and when you should be paying for them. We've identified 3 main factors which may influence why investors pay high fees. The returns of well-performing fund managers are a hot topic. Everybody wants to be investing their money with the best fund manager who gives the best returns. You will hear stories of some fund managers that have earned returns of 50, 60, even above 100% per year. So why wouldn't you want to invest with these people, regardless of the fees? In the UK, investors seem to have an obsession with following particular fund managers. This is linked to the prestige of a manager and their so-called skill. People seem to think that if a manager has achieved good results in the past, then they're going to be able to replicate this in future years and give them the best returns. Standard & Poor's release their SPIVA report every year, which gives information on active managers. They show that those active managers that actually outperform the index rarely do this in future years. This basically means that paying high fees for a manager can be a fool's game. The SPIVA report is a semi-annual analysis that basically compares the performance of fund managers to the relevant indexes that they are tracking. In the latest report, the general pattern from Europe is that fund managers tend to underperform their relevant indexes 70 to 75% of the time. But what about those that do outperform the index? From 2011 to 2015, the top quartile of US funds were tracked to see how many of those funds actually stay in the top quartile. At the end of a 4-year period, only 2 funds stayed within that top quartile. This shows how difficult it can be for fund managers to consistently outperform the index. So, in this context, paying high fees for an outperforming fund manager doesn't really make much sense. There seems to be only a handful of managers that can consistently outperform the index. The second reason why investors may pay high fees for particular funds is for access to particular markets. An example of these markets could be small cap companies or even the emerging markets. They are generally harder markets to track, so it costs more money to put the index together and to track it consistently. But investors accept that returns from this specific market are necessary to complete their portfolio. Funds that track investing factors are also common to see on many investing platforms. These factors include value, size, volatility, profitability, and even momentum. Research shows that from these factors you can achieve a higher equity premium for the risk that you are taking. But is this really worth it? At which point do the fees exceed the benefits of these funds? In this table, we can see the active return for a variety of indices compared to the MSCI World Index between 1988 and 2013. Over that time, the MSCI World Index had an average return of 7.1%. However, MSCI also produces factor indices that attempt to increase risk-adjusted returns. By comparing the factor index returns to the market average return, we get the so-called active return. In this case, active doesn't mean actively managed funds, but is instead the difference between the factor index and the benchmark. As you can see, the indices exposed to investing factors such as size, volatility, value, and momentum had higher returns than the benchmark index. BlackRock offers ETFs that track these factor indices at a low cost, around 0.3%, which seems reasonable, but active managers will charge significantly more. Take this Beresford fund for example. Its investing strategy is aimed at the low volatility factor, but it charges 1.02% in ongoing charge. Considering the expected return premium for minimum volatility in the MSCI analysis was 1.4%, it's hard to justify. Ultimately, if the fees associated with investing in funds that track these indices exceed the potential return, then is it worth it? The final and perhaps most prominent reason why investors are willing to pay high fees for their funds is for money management services. People are willing to pay high fees for the value that a money manager or a financial advisor can add to their portfolio. Fellow content creator Pensioncraft makes an excellent video on this. Often, institutions such as St James's Place combine services that will add value to your portfolio. These services include wealth management, investing advice, fund management, and tax advice. These services can be extremely useful for maximising your returns and making sure that you are investing in a tax efficient manner. It can also be psychologically beneficial to know that you have a professional looking after your money. This can often help you stay invested in market downturns where you would otherwise sometimes sell or panic. As PensionCraft points out, the clients of SJP don't mind paying the high fees because of the value-added service that they receive. This is because SJP are acting as a financial fiduciary on their behalf. This means that they are always acting in the client's best interest. However, you need to realise that there is a trade-off. At which point do these high fees start to outweigh the value of the service that is provided? Is it possible to put a price on the value of solid investing advice? That is tough to say, but we can put a price on high fees. This table shows an example of investing £12,000 each year for 40 years with a rate of return of 8%. If you were to pay 0% in fees, your return would be over 3.3 million. However, as the fees slowly increase, the return starts to drop dramatically. If you take a look at the 2% fees, for example, you are paying almost 1.4 million in fees. The bottom line is, there is a case for paying fees for financial advice, but don't tie this in with fund management fees. This leads on to our final point, which is how many people actually know that they are paying high fees for the funds that they are investing in. A recent article exposed the Phoenix Group for paying a 3% ongoing charge on their pension funds. This is around 6 times larger than the market average. This is literally daylight robbery. How many people actually know that they are being charged a ridiculous amount for investing in these funds? I bet that most people don't. It's easy to give your money to a company or a bank and allow them to manage your portfolio for you. But please be conscious of the fees that you are spending. What services are you actually receiving and how much are you paying for them? The chances are that you are conscious about investing fees. You are literally watching a YouTube video about them. But there are many people in the investing world that don't know about this. Do you know anybody in your family that invests? Maybe talk to them about it. See if they're investing with high fees. Do they even know about it? Through being open and talking with friends and family about these fees, we could actually save each other a lot of money. So, in this video, we've gone through multiple reasons why investors may be willing to pay high fees for their portfolios. Maybe you're paying high fees to access the funds of a successful manager. Maybe you just want to access a specific market, or you're chasing after the investing factors. Many people are paying for investing advice, which can be positive, but just make sure that you actually know what services you are receiving. And if you're paying high fees for these services, make sure that you're actually getting the most out of what you're paying for. And finally, some people may not even be conscious about the fees that they're paying. I recommend that you look at your broker now, compare it to other brokers, and see if you could actually be getting better value. Ultimately, a low-cost strategy will keep you in good stead. In some circumstances, it could be worth paying higher fees. Just remember that the average investor returns is the average market returns minus fees. There is literally no way around this. It is clear as night and day. If you are paying high fees for your investing, you are literally taking away from the returns that should be going into your pocket. I hope this video will be useful to help you consider why you actually pay the fees that you pay for your investing portfolio. If you think you're paying higher than you should be, then look into why you are paying those high fees. If you think you should be paying less, I guarantee that you could probably find a cheaper option. And with that, make sure to subscribe to the channel and follow us on Instagram at iQinvesting UK for more investing content every week. If you enjoyed the video, smash the like button and share it with a friend so that they can be conscious about investing fees too. Are there any reasons why you're willing to pay high fees that I haven't mentioned in this video? Let me know in the comments below. As always, thanks for watching.